Hello and welcome to another Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
As always, we'll be looking at key market charts, trends and risks. We'll discuss the impact of the new Treasury Secretary decision, Scott Bessent, over the weekend. And we'll also discuss Bitcoin. It's reached $99,500.
And then, looking at the Far East, we'll be looking at some of the data out of China as the CSI 300 and the Hang Seng have disappointed this week. And we'll also be focusing on European data as Europe continues to behave quite poorly over the previous weeks.
So the big news over the weekend, Donald Trump has elected Scott Bessent as the new Treasury Secretary. He's got a great track record in finance, a former partner of Soros Group Management, also the founder of Blue Square Capital. He's also highly regarded in academia, and the market likes this. They see this as a change from the non-stop spending from previous Treasury Secretaries. The US 10-year yield has opened up 8 basis points lower this week. As you can see from the chart, that's a fairly abrupt turn in the trend. The dollar's down slightly, and also gold has fallen quite aggressively too.
Yeah, it sounds as though Bessent is relatively pro-tariff, but I think a lot of people were anticipating this. And I think, as we can see, you can look to the downtick in gold as we will come to discuss, but that was seemingly one of the inflation trades that people were putting on, or perhaps more so a recession trade. Now, perhaps with Bessent at the helm, people are now less pricing in a recession, and so perhaps that will be part of the explanation for the lower prices in gold that we've seen.
Also, he's discussing reducing the budget deficit. So if we go back a few weeks, the trade that Stanley Druckenmiller put on is concern about the bond market and the fiscal spending getting out of control. He's looking to address this. So again, that's why we're seeing some money coming into the bond market. There'll be some people taking profit on those bond shorts. And then if we look at the data last week, we've had some fairly mixed data out of the US. Firstly, PMIs, came out strong, the combined number. Services has come out really strong. PMI service sector came in at 57. That's strong expansion, estimated to come in at 55. Manufacturing, though, remains in contraction, came in dead on expectations at 48.8. We look at the jobs data, weekly jobless claims are strong, but continuing claims, you can see from the chart here, have risen to 3-year highs. So what this means is people aren't being laid off, but those without jobs are struggling to find a new job.
Yeah, what you don't like to see is a degradation of the sort of the quality of the labour capital with people having prolonged periods of unemployment. So this data definitely is significant, but one of the things that's always worth saying when looking at these PMIs, services is a very large constituent part of the US economy. So having strong services PMIs is probably quite a good thing here versus the contraction in manufacturing.
Yep. And the US is still ticking along. The economy is ticking along. It's in growth, far stronger than what we're seeing in Europe and China. And what this has meant, of course, is the market has unwound the cuts priced by the Fed funds, the overnight index swap market. The overnight index swap now is seeing the terminal rate at 3.8%, the lows of the Fed funds. In September, this was at 2.7%. So the market's 1.1% higher. That's a huge move. The market's saying it's taken out 4 cuts by the Fed. That's why yields are higher, and that's why the dollar's been so strong in the last few weeks. On to gold. We'll bring that chart up. Interesting chart because we had a pullback 2 to 3 weeks ago. The uptrend has resumed, but you can see suddenly today we've started with an outside reversal day. The Bessent news, the market saying that the budget deficit will be addressed. And again, there's some profit taking in gold. Could be a significant point here in the gold trend.
Yeah, I think it's an interesting one, right? Because going into the US election with so much uncertainty, all-time highs had been broken and they were continuing their uptrend. It was very much a trending trade. The downtick over the previous week or so, defies that. But one of the things that is worth noting, and yet again we shall come on to talk about, is Bitcoin. Now, if you're speculators looking to get into a trending trade, the trending trade over the past fortnight has been Bitcoin rather than gold. So I don't think it's a particular surprise that you've seen a bit more selling in gold with this this trending trade of Bitcoin going up.
Absolutely. An interesting point with this chart of gold as well is if it turns here, you have a lower high. So the trend hasn't been able to take out the previous peak. Then all of a sudden, the most recent low about 10 days ago becomes the focus. If that gets taken out, then the trend following algorithms will unwind their positions fairly rapidly, and that will be the end of the uptrend. Onto equities, the S&P, and the S&P you can see here is been this recent move. It's a really strong move. It's in the top decile, so of S&P moves since 1928. This is the top 10% of strong moves higher. And are we getting to a level of complacency? We've talked the last few weeks how it's expensive. Yes, it is trending higher. But if you look at institutional investors, they've now built their largest US equity futures position in history. And then if we look at retail traders, they're going one step further actually. Last week, they took on their biggest ever weekly longs of leveraged ETFs.
Yeah, I mean, US equities continuing to be strong yet again, with the wind in their sails post the Trump election. But the question becomes, is this going to be oversaturated? I would hazard to say that in the long run, you might get, you might get an inflationary effect as well of these inflated equity prices continuing to pass on, strong returns to investors. But at the moment, there seems to be that they're going in one direction, and that managed money position going long. It's going to be hard to see people taking, the shorts are probably taking quite a lot of pain here. So seeing an immediate selling into that is a bit unimaginable for the short term.
Yeah, so the key is the trend is still higher.
Yeah.
Yeah, retail investors now the most bullish they've been in decades. And actually the equity futures have bounced this morning again on the Bessent news. That's being seen as a positive. But the warning signals, one of them is insiders sales have reached all-time highs. So this is the owners of stocks within the companies, corporate executives, they're selling now at record levels. And also Warren Buffett, Berkshire Hathaway have aggressively moved to cash. This has been historically a really good leading indicator.
Yeah, I mean, Berkshire Hathaway, it's been liquidating a number of its positions. It likes, its cash position at the moment. You do look at, some of the classic examples. Apple, they're a very cash-rich company. If you're seeing insiders continuing to sell into their positions, that's it can be an indicator. But if you're also, as a proportion of insider trades, looking at notional value, if you look at people like Nvidia shareholders, those shares are now notionally worth a lot, and therefore it's well within their incentive structure to liquidate some of their positions. So when you see blowouts in stock prices, perhaps that can skew the value that we see of insider trades in that sense.
Yep, Nvidia is an interesting one actually because those stocks have struggled to rise after last week's earnings. And if we look at AI or chip stocks, semiconductor stocks elsewhere, they're 30% off the highs. So again, there are warning signals, but right now the S&P, it's close to all-time highs, it's trending higher, but when it turns, it will be a fairly aggressive move. But whether that's next week, the week after, next month, who knows? Again, more signs of complacency out there. Credit spreads continue to trade towards all-time lows. S&P Global Ratings warned of bubble risks here last week. And there are now deflationary forces growing. The last year it was all about inflation. But in Europe, the five-year forward inflation swap has fallen to 2%, first time since 2022. We look at the University of Michigan consumer sentiment from the US as well. Inflation expectations fell to 2.6, the lowest since 2020. That's at the front of the curve, but actually 5 to 10 year expectations have crept higher.
Yeah, I mean, demand seems to be, especially out of Europe, not particularly strong, not breaking any barriers there. And I think, it wouldn't be a surprise from a demand management perspective that we continue to see rate cuts. Outside of the US, globally, it looks as though we're very much in that rate cutting regime that's still continuing. So it's understandable that unless monetary policy committees are proactive on this, we're going to be, the word deflation will be thrown around a fair amount.
Yeah, an interesting one. The Swiss National Bank chairman said nobody loves negative interest rates, including the Swiss National Bank, but we're ready to implement them if needed. The Swiss overnight index swap is pricing terminal rates of 0.11%. So the market's starting to edge towards negative rates in Switzerland. In fact, Euro Swiss this morning is trading at 0.93. It looks like there may have been some intervention on Friday, but 0.92 is the low. There's a sort of double bottom there with long wicks, but the market, Euro's trending lower. Switzerland's bearing the brunt of it. And we all know what happened with the Euro Swiss and the SMB intervention almost 10 years ago.
Yeah.
And Bitcoin trading 99,500. Will it reach 100,000? I'm sure it will, but of course it's sensible levels to take some profit. Is this a new paradigm we're in with Donald Trump talking about having a potential crypto secretary?
Absolutely. I mean, it looks as though, to very few people's surprise, Bitcoin has performed right after the Trump election, and breaking the all-time high. That wasn't an easy thing. It had flirted with this all-time high level a few times, and then
what was it, about 72,000?
74,000,
yeah.
I think. That's where
how quickly is that gone?
And yeah, absolutely, it blows out because once you have so many people looking at things that have a significant value. So whether it be an all-time high, or perhaps whether it be $100,000, it's a mentally nice number. You see selling at those levels, but then when that selling sort of gets whittled down and down and down, you can see these breakouts. And so this has been a really dramatic breakout. It's been a trending one. I wouldn't be surprised if we, spend a bit of time before actually breaking $100,000. Consolidation, absolutely, and also there will just be a flock of sell orders when it sort of comes in and comes near to that. The market, I think, looks at this new regime and is still questioning, are we in a new regime overall? There isn't a huge amount of clarity as to what the Trump administration is going to be doing with regard to crypto. Yes, involving people like Elon Musk, who's very pro-crypto in any cabinet or whatever. That would be seen as being bullish crypto in the long run, but there's not a clear pathway to crypto involvement and crypto dependency in the US. So I think the uncertainty does mean that there is a logical reason for people to sort of believe that this is overextended and this is a bubble. So I think it will, I think it's unlikely to surpass and settle above $100,000 in the next week or 2 weeks or whatever. And it may actually come off a fair amount over the next period, but it does seem as though this is a trending trade. It's trending upwards, and I would think it will be, continuing to, the price of Bitcoin will continue above the previous all-time high of sort of $74,000 for a good while now. Volatility's back for sure. Absolutely. What amazed me, I looked at the Ethereum chart last week, and that was about 20% off the highs. I presumed it would be making all-time highs. It wasn't. But then I read that speculators had their second biggest short position ever, and the following day it ramped up 9%. So they got absolutely smashed. But again, that's a huge risky trade to be short of Ethereum when Bitcoin's going up so aggressively. On to Brent. The same chart we keep bringing in, highlighting how narrow the consolidation gets. And when it breaks, it's going to be aggressive. Which way, we tend to have a company view it's going to be down on slowing demand, but Middle East tensions Yeah, I mean, we continue to see Middle East tensions, and also that's fundamentally a bullish flat price factor, and then re-escalation in the Ukraine-Russia situation. That also ought to be bullish, but headlines just seem to be sort of getting lost along the way here. It doesn't seem as though that much is having a reaction. I think people are, relatively happy to be for crude to be in this $70 to $75 range. It'll be interesting to see what happens with, yet again, the Trump administration, whether we're seeing a huge amount of production increases. Will any production increases be a downward price effect? Would that be mitigated by rebuying and restocking up of the SPR, the Strategic Petroleum Reserve? I can see us maintaining in this relatively low volatility zone for a good while now. Obviously, it would be naive to think that volatility is going to continue to be continue to downtrend, but I think we might well be stuck in this period of a sort of $5 crude range for a good while now. And if you read, Twitter expert A versus bulge bracket bank B, everyone seems to have differing ideas about where Brent is going to be in 2025. There doesn't seem to be too much of a consensus. Consensus is amongst speculators, and that being fed back to journalists can have a notable impact. It can influence people's decisions, but because there is no consensus, I can see us maintaining this narrow volatility.
I think with recency bias as well, you forget just how volatile oil can be. We saw last year it go to 130. We've seen it. I remember oil at 148. I remember it in 6 months it going to 28. Same in 2014. It went from 108 to 28, and we've seen minus 40 with the storage issues during COVID.
WTI contract, yeah.
And again, interesting chart when we look at the 10-year yield and oil. Again, there's no great reason why they should be correlated. Of course, one is inflationary leads inflation. But you can see actually it's starting to converge again. Oil price ticked higher last week, although it looks like it's leveling out today. It's rallied in the last 10 minutes, but you can see the 10-year yield of the Bessent news. Maybe the fears are being taken out of the bond market, so that's good news, and we'll see these two converge again.
Yeah, I think also to some degree it's worth noting what we're seeing in the crypto space and in gold. A lot of people I think are perhaps using these, whether it be managed money, whether it be retail, people are using these vehicles as a way of proxying, perhaps it be, US or global productivity, and rather than Brent, as the sophistication of the crypto market continues to evolve, you will see more speculative money going into that. And so perhaps you're going to be seeing less of a demand effect coming from Brent with managed money in that situation.
Definitely. So we've seen a stronger dollar. Again, that's maybe turned marginally today, but the strong dollar, huge impact on emerging markets. And you can see from the chart here, euro dollar, it's trending, looks like it's heading back towards parity. We'll come to the European data in a minute. European data continues to be weak, while the US, we're seeing strength in the US economy. Certainly we highlighted this at 108.80. Now it's trading around 104, but we highlighted selling the euro dollar then, but I think parity is certainly the next target.
Yeah.
US housing, some data that came out last week. US mortgage demand is now down 50% from the same week in 2019. 30-year mortgage rates have also risen to 6.84, highest since July. It makes sense. Yeah, mortgages are more expensive.
Demand's lower, exactly. And yeah, one of the things that's I love mentioning at the moment is what you're seeing is prospective first-time buyers are, inflation is really affecting them. We're seeing regressive inflation because of increasing rental prices. The available money for savings and to put down for a deposit and get a mortgage is reduced, and therefore you're seeing this regressive inflation, impacting lower income people, but also first time buyers. So US mortgage demand being weak is not surprising to me on that basis.
Yep. Also, housing completions are higher. We can see that against housing starts, which are falling. Housing completions higher means more supply coming onto the market. More supply, less demand. House prices can only go one way from here. Interesting point with housing completions. Housing starts are falling. Housing starts fell 3.1% in October. The impact this has is actually going to be on the jobless data, because if there's less housing starts, all of a sudden those workers, those labourers are going to be, construction are going to be laid off, and that's going to impact the jobless data going forward. More signs of concern for the US consumer as well. Consumer credit continues to tighten. Credit rejection rates are rising from credit cards, mortgages, autos. You can see the data, it's pretty concerning here. We talk about equity markets. Again, that's good for the higher incomes, but we can see inflation, that's hurt low income households, and you can really see it beginning to bite here.
Yeah, it almost looks as though the consumer is going to be perhaps facing some of the credit tightening that some of the US government looks as though it's going to be focusing a lot on credit and their ever increasing debt. So if they're looking to get that under control, we're going to be seeing it on the individual level as well.
On to China. We've had a weakness in the China equity markets. Chinese CSI 300 fell 3.1% on Friday. The Hang Seng is at 2-month lows. You can see here from the CSI 300, you can see exactly where the stimulus came in. Again, the government has been giving effectively loans to investment companies to buy stocks. That has to be bullish, but what we can see now, short-term trend is definitely lower. So the PBOC has to be concerned about this going forward. Also, investors are fleeing Chinese ETFs. You can see record outflows in Chinese ETFs last week as continuing uncertainty looms. We're going to need more stimulus.
Yeah, absolutely. And I think one of the things that the Chinese government is also very concerned with is poor data on housing. So they're going to be keen to really prop up both equity markets but also housing markets in China. Production doesn't seem to be fantastic out of the east. Demand going to be weak. So yeah, more stimulus packages on the horizon, I would suspect.
And it needs to support the consumer.
Yeah.
On to Europe. German PMIs came in far worse than expected at 47.3. French PMIs came in at 43.2. Again, really strong contraction here. UK PMIs also worse than expected, came in below 50 at 49.9. They were expected at 51.8. And you can see from the chart, PMIs showing, or manufacturing PMIs, I should say, showing widespread contraction. This will be less demand for energy products, as we're saying.
Absolutely. I mean, yeah, looking at the UK PMI stuff, we were expecting 51.8 in overall, and then that the significance of that versus the 49.9. The 49.9 ought not necessarily to be a worry. It only very slightly shows contraction, but to anticipate a period of expansion and for that not to be met is worrying. Some really worrying signs coming out of Germany and France, and there's also been headlines about significant job cuts in Germany. So Deutsche Bahn cutting 30,000 jobs, Volkswagen expecting to cut between 5,000 and 30,000 jobs. So this is all quite worrying for German manufacturing. This has an impact upon German energy demand, and as we come to see on the data, we've been despite all of this, German power futures have actually been quite strong. If you're looking into Q1 2025 or the whole calendar year of 2025, they've been increasing. So I expect that if we're seeing manufacturing continue to be lackluster, this ought to notionally come off from these levels that we're seeing here.
And going back to that UK data, that was the overall PMIs. If we look at the manufacturing, that was expected to come in at 50, came in at 48.8. So that's actually gone from expected to be flat to, as you say, contraction. More dovish comments from the ECB as well. ECB's Villeroy said inflation could be sustainably at 2% early 2025. It also said risks to growth and inflation are shifting to the downside, and ECB should continue to reduce rates from restrictive policy. The clear signals here, interest rates points again to euro dollar continuing to the downside. On to the UK, on the back of the PMIs, we had CPI jumping to 2.3%, expected to be at 2.1%. So this is bad news for the central bank. Again, last week we saw unemployment jumping from 4.1 to 4.3. So bad news for the central bank again, and retail sales falling 0.7% month on month, expected down 0.3.
Yeah, and I think it's worth, paying a fair amount of attention as well to the political situation in the UK. There seems to be a fair amount of discontent with the new Labour government. There's been a petition that's now circulated that's nearly at 2 million signatures calling for another general election. And I think a lot of this is inspired by worries about the economy going forward. The central bank may well have its hands tied quite a lot with this CPI data, and seeing a fiscal policy. It sounds as though we're going to be having quite an interventionist Labour government there. So people are worrying, I think, about the state of the UK economy in the long run.
If there are worries with Liz Truss as well, there certainly have to be worries here.
Absolutely.
An interesting chart pulled up, these sterling against the yen. So the sterling OAS has about 75 basis points of cuts priced in the next year, but Japan has 46 basis points of hikes. So if there's concerns around the political outlook, then selling sterling yen, and it's clearly turned and in a short-term downtrend here, that would be an interesting trade to put on.
Mm.
Some big movers since the election. Dogecoin up 130%, MicroStrategy up 74%, Tesla up 36%, Bitcoin 42%, banks are up 10%, but some of the losers, Treasury is down 2.5%, China down 7%, Novo Nordisk down 7%, Pfizer down 9.7%. We've seen Kennedy coming in to be head of the health secretary.
Yeah, I would expect the Novo Nordisk and the Pfizer news to be, a sign of what the attitude of the Trump administration will be towards, not only things like vaccines, but their attitude towards healthcare companies like this. And then, obviously Trump media down as well.
That surprised me.
That was perhaps the surprise.
Trump media down 10%, and volatility, interesting one, down 18%. So central bank OAS pricing for the next 12 months. The the market's just pricing 62 basis points of cuts from here. ECB 148 basis points of cuts. Bank of England 75, as we said. Big difference between New Zealand and Australia. New Zealand 156 points of cuts against Australia's 50. We'll have a look at the Aussie Kiwi chart in a second. And again, Bank of Japan 46 basis points of hikes over the next year. And the market's now pricing 10 basis point hike on the 19th of December. That would strengthen the yen as well. So Aussie Kiwi trending higher. Again, interest rate differentials are a key to FX. You can see here we have the 10-year interest rate differentials against the currency, and Aussie Kiwi has a fair bit to play to catch up here. And finally, dollar yen against the interest rate differentials. With the US having taken out, the OAS taking out all the cuts, it's looking pretty tight now, just 62 basis points of cuts in the US. So that might start to price some cuts on any weak data, but clearly the market's hunting hikes now. Interest rate differentials now favouring Japan, and dollar yen is starting to head lower on the back of that. So the week ahead, well, it's Thanksgiving this week, so it's going to be a short week in the US. We have Fed minutes out on Tuesday. Wednesday, the PCE price index, the second reading of Q3 GDP and durable goods orders. Thursday's Eurozone inflation, Canadian GDP. And as we said, it's Thanksgiving in the US. Friday, we have some consumer sentiment. And Saturday, Chinese manufacturing and service PMI data. Probably Saturday's the key data of this week.
I think that's the big one to pay attention to, and we can be looking at some interesting stuff on Monday morning as that filters through.
Excellent. So thank you for joining us. Hopefully you have a good week. Happy Thanksgiving, and thank you very much.
Thank you.